This session is on 1031 tax deferred exchanges for the Commercial Board of Realtors of Michigan. My name is Jim Gudenau. I'm with First American Exchange Company, and I would like to welcome you all here today. There's going to be several topics today, including, in general, what is a 1031 exchange, what is like-kind, timeframes for an exchange, common misconceptions, capital gain and boot and other tax ramifications, the same taxpayer requirement, what is a qualified intermediary or QI. Very briefly, we'll go over some reverse and improvement exchange issues, and then wrap up with some key points to remember. What is a 1031 exchange? As long as a property is held for productive use in a trade or business or for investment, so non-personal use, it can qualify for 1031 treatment. It's important to remember that transaction is tax deferred, not tax free. The deferred gain stays built into the new property and will become payable if and when the property is ultimately sold. To complete the exchange, the investor must sell and buy qualified property and, in most cases, engage the services of a qualified intermediary to administer the exchange. The investor delays paying the taxes on the gain of the investment property. It simply is a deferral of the tax. If the investor ever sells the replacement property and doesn't do another exchange, they'll have to pay the taxes owed on the property on the sale of the property that they previously exchanged. The 1031 exchange has been around for quite some time. Federal income taxes were instituted initially in 1918, and a version of the Section 1031 that allows for the deferral of gain on the sale of investment properties has been around since 1921. The 1031 has evolved and changed over time, primarily through case law. And an example of how exchanges have changed over time is originally the investor could hold their own funds from the sale of the investment property, and there were no time limits on when the replacement property had to be acquired and complete the exchange. The 1031 is part of the Internal Revenue Code, which is federal tax law, and most states do follow 1031. There are some states that have the investor, where the investor may still have to pay certain taxes, for instance, Pennsylvania, or withholding, regardless if the investor is completing an exchange. The 1031 is a tax code provision that provides the tax benefit available to investors. As I mentioned before, it's property held for business use, production, income, or investment. And to complete the exchange, the investor must sell and buy similar property. The 1031 exchange is widely known and utilized by investors to defer the capital gains when buying and selling investment property. To qualify under 1031, basic requirements are to acquire like-kind property to be held for investment or productive use in a trade or business. The replacement property must be identified within 45 days of closing of the relinquished property. Any and all cash proceeds from the sale must be utilized to acquire the replacement properties. And the replacement properties must be of equal value or higher, and all must be acquired within 180 days. The same taxpayer that sells the relinquished property must acquire the replacement property, and in order to meet the safe harbor, the use of a qualified intermediary must take place. What are qualifying properties? So it is any property held for investment or productive use in a trade or business. The best way to remember it is non-personal use property. So this isn't something you're going to utilize for your primary residence or your vacation home if it's primarily used. Even if you rent it out a little bit, it might qualify, but ideally these are just income producing properties or properties held for investment. And in order to qualify, it must be exchanged for like property, which we'll go into a little bit deeper shortly. As I mentioned, primary residences don't qualify for 1031. It's under a different code section. That's section 121, which has its own set of rules, holding periods, duration of utilizing as your primary residence. Other non-qualifying properties are stocks, bonds, and notes, interest in a partnership or LLC, and inventory, which can apply to certain investors if they're flipping properties on a regular basis. The IRS can look at that as their dealer property. Those properties are inventory because they're not being held for investment. They're simply being held for resale. You need to be very careful about that aspect. And again, in most of the cases of this, and I'll say this a couple times throughout, the taxpayer or the exchanger is going to need to refer to the advice of their primary tax advisor, whether that's their CPA or their tax attorney. Other things that don't qualify, cash and foreign properties do not also qualify. You can exchange U.S. property for U.S. property or foreign property for foreign property, but can't mix the two. So to further on, what is like kind? The easiest way to think of the like kind is real estate for investment or business purposes. An investor can sell a single family home that is held as rental property and buy a multifamily home, or sell a multifamily home and buy a retail or office or industrial property. It's not the type of property held, it's the primary purpose for holding the property. Even land easements and certain oil and gas royalty interests can be exchanged. So the type, like I said, is not important. The reason it is held for the productive use in trade or business or an investment, that non-personal use is the underlying held for purpose the IRS is referring to. There are many gray areas within the 1031 arena, but the timelines and the identification requirements are two areas that are definitely black and white. Although many investors are aware that they must identify replacement property within 45 days of the relinquished property transfer and close on the replacement property by the 180th day, they're sometimes unaware of the specific identification requirements that must be met along the way. That 45-day identification period has some very specific guidelines on what is considered properly identified. An exchanger may sell and buy as many properties as he likes in a 1031 exchange, subject to the following identification rules. The first is the rule that almost is the most common, and that's the 3 property rule. Exactly what it sounds like is the exchanger can identify up to 3 properties, regardless of the market value of the properties identified. So if they, for instance, sold $1 million property, in order to completely defer the gain, they have to buy $1 million in replacement property. They could identify 3 $1 million plus properties, or if they had planned on diversifying, they could identify 3 $600,000 properties and acquire 2 of those and break the $1 million threshold. The second method is the 200% rule. If the exchanger decides to identify more than 3 properties, so 4 or more up to an unlimited number, the fair market value of all those properties identified cannot exceed twice the value of the relinquished property. As in my previous example of the $1 million sale price, they could identify as many properties as they'd like, as long as combined fair market value does not exceed $2 million. This is not as common as the 3 property rule, but it is often used when people are trying to diversify. So if they have one very large asset and they want to diversify both geographically and property type, oftentimes they may utilize 200% rule. The thing to remember in 200% rule is if that 200% threshold is exceeded, a third rule kicks in, and that's called the 95% rule. So if the taxpayer exceeds the 200%, the IRS requires that 95% of all properties identified, which is based on the fair market value of those properties, must be acquired to have a valid exchange. So it's an all or nothing proposition, where if 94% of the value is acquired, the entire exchange is busted, and the capital gains will need to be paid on the entire, based on the original sale of the property. So as mentioned, the 45-day rule is midnight on the 45th day after the transfer of the relinquished property. Anytime prior to that time, the exchanger can identify replacement property, as long as, and if in the case a property happens to sell, or they do their due diligence and realize it's not a property, and really wanting to acquire, they can, as long as we're still within the 45-day window, they can revoke that property and re-identify a different property. However, no changes can be made to the identification of property after the 45th day, and any properties acquired must be listed on the most current identification notice. So you can't mix and match. If a property was revoked and different property identified, the most recent identification is the one that prevails. Documentation is crucial to prove that the exchange timelines and the identification requirements are met. That's why working with a experienced qualified intermediary who understands the process is of the utmost importance. The exchanger does not have to be under contract to purchase the property to list it on the identification form. Although it is recommended that they have at least one property under contract under the 3-property rule, it's not required. It should be looked at as there's a primary property with a couple of backups. It's important to understand that once the exchanger has identified their replacement property, they can only close on any or all the properties listed on that form. We cannot utilize exchange, the QI cannot utilize exchange proceeds for any properties except those on the identification form. In order for the exchanger to complete a fully tax-deferred exchange, they must purchase replacement property valued at equal or greater than the value of the property they sold. So within the 45 days of the transfer of the relinquished property, the exchanger must identify in written documentation signed by the exchanger, usually on an identification notice or form provided by the qualified intermediary, the property intends to acquire. This is, as I mentioned, it's due by midnight on the 45th day, and this is regardless of the 45th day is on a weekend, a holiday, as it goes, same for the 45 is the 180. These are calendar days and do not take into consideration any holidays or any weekends. So it is imperative that the calendar days are followed and not business days. The identification notice must be either hand-delivered, mailed, faxed, or otherwise sent to, and he uses directly from the IRS. 1, the person obligated to transfer the replacement property to the taxpayer, such as the seller of the replacement property, or 2, any other person involved in the exchange, such as the qualified intermediary, escrow agent, or title company, other than a quote-unquote disqualified person, such as agents or family members of the exchanger. Most identification notices are sent to and kept by the qualified intermediary. Potential replacement properties must be unambiguously described by street address, legal description, assessor's parcel number, or distinguishable name. If the property has a unit number, it's important that the specific number be used to identify so that the exchanger does not mistakenly identify an entire subdivision or complex. Similarly, if the property being acquired is a tenancy in common interest, the exchanger must identify the percentage interest you will receive in the exchange, not the entire property. If the exchanger plans to sell more than one property under one exchange, the 45-day and 180-day timelines will begin to run from the date the first relinquished property closes. And just a practical tip, since the timelines do not start to run until the relinquished property is actually transferred, an exchanger may try to negotiate a later close of escrow on the relinquished property if he needs more time if he thinks he's going to need more time to identify replacement property. The exchanger has up to 180 days to acquire the replacement property. However, you need to remember for exchanges that close between October 18th and December 31st of non-leap years, a tax filing extension may be necessary to ensure that they can get the full 180 days. Technically, it is the earlier of 180 days or the due date of the exchanger's tax return. Once the relinquished property closes, the exchanger should never file their tax return before acquiring the replacement property. If for some reason the exchanger is unable to close on any of the properties on the identification form, they cannot substitute another property after the 45 days and will have a failed exchange. And ultimately, it'll be treated just as a simple sale and have to pay the capital gains and any other tax liabilities from the sale of the property. There are no penalties or interest for not completing the exchange. And in order for the exchanger to complete a fully tax-deferred exchange, that they must purchase replacement property valued at equal or greater the value of the property they sold. They must put equal or greater equity back into the replacement property, and they must have new debt equal or greater to the debt they had, or they must bring additional equity to the transaction, where in this case, the new equity can replace the debt. There seems to be a little bit of confusion about this item. I've come across a lot of people who think that they only have to reinvest the gain into a new property and not the entire value of the sale price. And they think if I had a $1 million property and had a $200,000 gain, I should only have to put my $200,000 gain back in. That is not the case. It's the full fair market value of the property that was relinquished. Another challenge they come up with is the lender will tell the exchanger that they don't need as much down as the cash equity that is being held by the QI. Unfortunately, the equity needs to be used before any additional debt should be utilized. There are lenders who want to send the full amount of the loan to closing, which could create a tax issue for the exchanger, where if the IRS looks at the closing statement and sees funds going back to the exchanger at closing, they could treat those as taxable equity versus new debt. So they could completely blow up the entire exchange. And so, as I mentioned, equal or greater in value, equal or greater in equity, equal or greater in debt unless there's new equity, and partial exchanges are allowed, so you can take taxable boot. Here's a quick example where we've got a relinquished property valued and sold at $2 million with $1 million debt, so it has $1 million equity. The replacement property is $2.5 million, so obviously we went up in value. As a result, we went up in debt, and the full $1 million in equity was utilized. So because we're equal or greater in value and equity, there is no boot. Another example we've got is, again, we'll stick with the $2 million relinquished property value. This time $1.4 million in debt, $600,000 in equity. We found a replacement property we thought was going to be worth $2 million, and actually ended up negotiating it down due to some shortfalls in the property. So we got $1.8 million purchase price, and instead of needing the full $1.4 million in debt, we only need $1.2 million. Fully utilize the $600,000 in equity, and the $200,000 shortfall results in a $200,000 boot. So there's still a valid exchange, but just a partial versus full dollar value, resulting in the boot for the taxpayer. Some of the common misconceptions additional are that the property must be of the same type. Residential for residential, office for office, industrial for industrial, but in reality, that's unimportant. It's the purpose of ownership, that held for that I mentioned a couple of times. As long as it's held for the productive use in a trade or business or for investment, That's the underlying practical theory from the IRS's perspective. And it's that the taxpayer had the intent to keep the property for one of those reasons, investment, business use, production of income, and not for sale and not for personal use. There is no bright line test that determines how long a property must be held. A lot of people, how long do I have to hold it before I can either sell it or exchange it again? Or, in some cases, they may want to convert it to personal use or what have you. There is not a bright line test. Some tax advisors are comfortable for a year or more. Others think it should be 2 years. There's so much gray in this area, it's hard to give it, and there's so many other underlying factors that could treat each, which would make each need to be treated case by case. So that's definitely a conversation that needs to be had with the tax advisor. Another misconception is that, hey, I'm close to my 45 days, I can't find anything that I want, I can just buy this property that mom and dad have held for 40 years and I can, do an exchange and buy that property, and then they can just, cash out and walk away. There's definite limitations if there's a related party involved. The IRS views these as opportunities for people to do some basis shifting, which means the overall tax picture for the related parties would benefit from the transaction. So when a replacement property is purchased from a related party, that party will also need to do an exchange. The IRS doesn't want to see anybody cashing out or walking away, related party walking away with cash in hand. And then they are also both then required to hold the replacement property for 2 years. Again, some additional exchange myths that exchangers have to find someone with property to swap. In the old days, that was 1031. It was very often, I'll swap your property for my property, here we go, and walk away. It doesn't have to work like that. We can sell to one party, buy from a third party, and there's no need to actually have somebody to swap directly with. Again, the need to buy the same type of investment real estate, we discussed that a couple times already. The type and quality of the property is relevant as long as it's being held for that productive use in a trade or business or investment. Some people still believe that the transaction needs to be done simultaneously, which we've already talked about, the 45 and 180 day deadlines. And there's also the misconception that they're expensive and difficult and should only be done for large properties and huge gains. I'd say the industry average for an exchange, anywhere between $500,000 and $1 million is probably $1,000, maybe $1,250, somewhere in that ballpark. So it's not that expensive. If you're deferring, $25,000 or $50,000 in taxes, it certainly makes sense. It's not necessarily difficult. Is it got some complexities? Yeah, but that's why the qualified intermediary is involved, and that's why maybe the taxpayer is involved or the tax advisor gets involved as well. People think that just because you do 1031 exchange, you're going to increase your chances for audit. Not necessarily true. And also that if you live on part of the property, that it can't do an exchange. There are a lot of duplexes and quadplexes that can very easily qualify for 1031 treatment, and the portion of the property lived in by the taxpayer could possibly qualify for the 121 treatment that we talked about before, where it's a primary residence. There's also people who think they can have their attorney or their CPA hold the money and act as the intermediary on these types of transactions. They're actually a list of disqualified persons, and that attorney or CPA or several others are disqualified from acting as qualified intermediary. And many people think they can just do a sale and then do a purchase, and since they met the dollar value guidelines, they can call it an exchange and then self-report it to the IRS. which is absolutely not true. One of the biggest tenets under 1031 is that the exchanger does not have actual or constructive receipt of the funds. If the taxpayer ever does have actual construction receipt of the funds, the exchange is immediately busted. So they cannot just do the transaction on their own. And again, why exchange? Again, there's many reasons to an exchange. Perhaps you're maxed out on depreciation on the existing property, where maybe you want to sell a property, buy a property of higher value, and then you don't have an additional tax basis that wherein you can get new depreciation allowances. There may be co-owner problems, whether it's partnerships ready to split on or split up, or people want to go their own way, or it could be tired of being a landlord. Maybe you own 25 single-family residential houses, and just that burden's getting to you. Or, hey, you know what? We're retiring to Florida, and I'm not going to be in Michigan anymore. Do I really want to have property there? Maybe I'll sell my Michigan property and find something in Florida to invest in. Additionally, it could be, leverage the tax deferral benefits. You sell a property. If you sell a property or you do an exchange rather than a sale, there's going to be more cash available to reinvest into the new property, and it can be leveraged even further. It may be something to improve cash flow, and diversification or consolidation. I brought both of those up already, where you may want to sell that portfolio of 25 houses and simply buy a small triple net lease property or something to that effect, and then just invest into one larger investment. So the next section is the real underlying premise on why we do 1031 exchanges. It's to defer the taxes. You're allowed to avoid taxes. You're not allowed to evade taxes. So this is a legitimate tax avoidance. And things we have to look at are what kind of tax rates could affect the sale. Let's say if we've got a property that we've owned for less than 1 year, any sale of that type of property is going to be taxed as ordinary income. Once we get to a year and a day or more, that'll switch to long-term, wherein if the incomes are below $441,450 for an individual, or $496,600 for married, you got 15% cap gains tax on the appreciation, and in all cases 25% recapture on the depreciation. If the incomes are above those limitations, the cap gains rate increases to 20%, and the depreciation recapture still remains at the 25%, regardless of income level. In addition to that, we've got a 3.8% unearned income tax. This went into effect in correlation with the Affordable Care Act, or Obamacare, as many people know it. And it'll apply to individuals with an adjusted gross income over 200,000, or married couples with an AGI over 250. When you start talking about those, the additional taxes due for the sale of real estate, it's going to be real easy to get to those levels. So again, like we said, why exchange? And it's all taxes. So here's another example where we've got a $100,000 property that was acquired for $100,000. It has been depreciated $50,000, so we've got an adjusted basis of $50,000, a sale price of $800,000. So we're looking at a $700,000 appreciation, the $50,000 depreciation. So we're looking at $700,000 at 15%, $50,000 at 25%. And on a pure sale, that would result in a $117,500 tax bill. We've got there's always some question regarding what expenses are qualified to use proceeds from sale, and there are certain items that are considered qualified exchange expenses. And that's there's some gray area, obviously some gray area in this. The IRS doesn't have a list, here, this is what qualifies, this doesn't. But Revenue Ruling 72-456 provide that if exchange funds are used to pay brokerage commissions, it does not result in the transaction being partially taxable. So that's the brokerage commissions are allowable expense. As I mentioned, there's no clear rulings on the subject, but there's a number of items that a lot of tax advisors agree would be considered allowable expenses. And these would include appraisal fees required by the purchase contract, exchange fees, the fee paid to the QI, transfer taxes, escrow fees or recording fees, the title insurance for the owner's policy, and attorney's fees incurred in direct connection with the sale or purchase of the property. Some of the other items that are found on the closing statement but are generally not considered exchange expenses, if they are utilized to pay the exchange expenses, it could result in a transaction being partially taxable. The payments probably will, in most cases, will not invalidate the application of the qualified intermediary safe harbor, but they'll probably still constitute boot to the exchanger. On a typical settlement statement, the seller of the relinquished property will give the buyer a credit against the sales price, representing security deposits and prorated rents. Effectively, the seller was using exchange funds to pay the security deposits and the prorated rent amounts to the buyer. To avoid the taxable event, the seller should deposit either his own funds and pay those security deposits and prorated expenses to the buyer rather than give him a credit, or even oftentimes you can see certain expenses paid outside closing. Most tax advisors also believe that the fees and costs paid, any fees and costs paid in connection with getting a loan to acquire the replacement property should be considered costs of obtaining the financing, not costs of acquiring the replacement property itself. Thus, they're not qualified exchange expenses. To avoid any potential tax liability, the buyer may want to deposit his own funds to pay those loan-related expenses. Some of the non-exchange expenses can be created tax liability, but are often offset by qualifying deductions. And one example would be property taxes. Although they're not an exchange expense, they'll get a deduction for paying the property taxes, and that liability will be offset by the deduction. These items are typically considered not qualified exchange expenses because they did not directly relate to the disposition of the relinquished property or the acquisition of the replacement property, and that would be loan costs and fees, title insurance fees for the lender policy, any appraisals and environmental investigation costs that were required by the lender, security deposits, prorated rents, insurance premiums, and again, property taxes. It's important to remember that the primary rationale for the tax deferral is that the taxpayer has merely moved his investment from one property to another. The separate but important issue is whether paying a non-exchange expense from the exchange funds will be looked at by the IRS as constructive receipt of those funds by the investor, which has the potential to disqualify the entire exchange. Under the regulations, the exchange funds can be used to pay those transactional items that relate, again, to the disposition of the relinquished property or the acquisition of the replacement property. Commissions, prorated taxes, recording, transfer taxes. The investor may want to use exchange funds to pay a rate lock fee to the lender. Since these fees by their nature are paid before closing, they are not strictly required for the acquisition of the replacement property, and paying the fee from exchange funds will likely trigger a constructive receipt issue. And this is something that could completely bust an exchange versus just creating a boot issue. Since there's no clear IRS guidance, it's important that the investors discuss any of these issues with their tax advisors before trying to use exchange funds to pay potential non-exchange expenses. whether it's prior to or at the replacement property closing. Now we're going to look at the same taxpayer requirement. This issue comes up more often than not when there are a husband and wife or a LLC or partnership where people are exiting or trying to exit the that partnership or LLC. So if the partnership owns a relinquished property, the partnership must acquire the replacement property. If XYZ Corp owns relinquished property, XYZ Corp must acquire the replacement property. A little bit of difference here is if the revocable trust or grantor trust owns relinquished property, the grantors can acquire the replacement property in their individual name. Same with Mary Jones. If Mary Jones is a sole member of Jones LLC and it's a disregarded entity for tax purposes, that LLC can acquire the replacement property. If John Smith has 100% fee interest in the relinquished property, John Smith can acquire a 20% tenancy and common interest in the replacement property. So there's definitely even though it's the same taxpayer, there is a little bit of flexibility in what it appears. And as I mentioned, one of the things that where we see this issue the most is if property was acquired prior to a marriage by one spouse or and then brought to the and had never been redeeded to reflect the co-ownership or the spousal ownership. They may want to add their spouse to title the replacement property, or the lender may require the spouse to be entitled for a loan. So these are issues that could present a taxable event. It may not be a 1031 issue, but it could be a gift tax issue. And then this is why it's very important to have the tax advisor opine on this before adding the spouse to title on any replacement property if the spouse was not entitled to the relinquished property. Again, who can exchange and what is a disregarded entity? So if an individual or a company or a corporation or a partnership or a LLC is the sole member, single member of another LLC, that LLC can be disregarded for tax purposes. The IRS allows this in the 1031 arena. It's very heavily used actually in the reverse exchange area of 1031 exchange. And so for that, under those guidelines, the single member LLC is fairly clear. Now, where we run across something where it may or may not be so clear is in some states, husband and wife may be considered a single member of an LLC, depending on whether it's community property state or not, or again, a revocable trust, as we mentioned on the other slide. So this is, again, definitely one of those areas where the tax advisor needs to make sure that the things are handled to make certain that the same taxpayer requirement is met. Some of the red flags that indicate that there might be a same taxpayer issue is if we've got a partnership where the partners who sold the relinquished property are trying to acquire replacement property in their own names or something to that effect, or that an exchange might be completed with a related party. So again, those kind of send up danger signs, the red flags. Speaking of partnerships, there is, as I mentioned, you might have a partners that want to exit, and there are it's very common for either one partner wanting to either just exit the partnership, sell the property and cash out, pay their taxes and put some money in their pocket, or there may be another partner or partners who aren't ready to exit the real estate realm and want to do an exchange. One of the most common ways to accomplish this is what is referred to as a drop and swap. And then in this case, this is where there's exiting partners who want to take cash out, but partners who want to remain. So we got one or all, one out, want to go their separate way. And the way to accomplish this is by dropping the interest out to the individual partners prior to engaging in the sale of the relinquished property. So if the relinquished property is sold under the partnership name, that partnership has to require the property, and otherwise it'll be a busted exchange. So what's important to remember, what is the drop? Let's get into it a little bit. I kind of skimmed over that. The partnership itself will make a liquidating distribution to the partners prior to the sale of the real estate. So let's say we have 5 partners, each own a 20% interest. The partnership would make a liquidating distribution to each partner in the form of a 20% tenancy in common interest. The partnership would be dissolved. The now co-owners would have a co-ownership agreement, which would specifically state they are not to be treated as a partnership for tax purposes. And when that property is finally sold, you will actually have 5 sellers, the 5 previous partners, each to their own 20% tenancy common interest. Ideally, this will be done well in advance of the sale. There's no tax implications on that drop, on that liquidating distribution, until the property is sold. And this would allow when the property is sold, one former partner could do an exchange. All of them could do an exchange and go their own way, or some could cash out, some could pay the tax bill. It gives it just a lot more individual. It gives each individual former partner flexibility to do that. The big thing important factors that IRS look at is when that drop occurred. We want to, if this is something the partnership should plan for in advance. This is not something that we should be doing right before the property goes under sale. The property, if it's going to be listed for sale, should list it as tenants, the sellers as tenants in common. They should negotiate and enter into the purchase and sale agreement as tenants in common. And it's vitally important that that purchaser know that these are multiple sellers and not in partnership. The swap and drop is the alternative to the drop and swap. So instead of dropping out the TIC interest and having individuals do their own swap, this is where the partnership would swap, performs the exchange, and then would liquidate post-exchange. This is usually a little harder to accomplish because in many cases, those partners who want to exchange on their own, it's difficult to find a property that they're going to be interested in and they're going to want to continue an investment. So what is a qualified intermediary? Just a little vernacular for you. Qualified intermediary, also known as a QI, sometimes known geographically referred to nationwide, could be referred to differently as an accommodator or a facilitator, but under the regulations, specifically clear what a qualified intermediary is. And that's that independent third party that meets the safe harbor guidelines of the 1031 regs. So, you know, how does one go about what is a QI? How do you find one? How do you pick one? Ironically, there's no federal regulations on who can be a qualified intermediary, although some states have regulations. So what is important to do is look for a QI that has financial strength, a long track record, security, knowledge and experience, and qualified per the regulations. There is a large industry group known as the Federation of Exchange Accommodators. There's really good materials on their website on how to pick a QI and how to vet and most often, there's also a list of those QIs that are members of the Federation and, meet most of the bullet points that I have listed there. So unless two people are actually swapping property for property, here's mine, here's yours, the IRS requires that taxpayers deposit their 1031 funds with a qualified intermediary. If they do not, they will have constructive receipt of the funds and the taxes will be due. There are other safe harbors that are less commonly used, but the QI is a key point and always involved to make certain that doesn't happen. And the QI's role is respected by the IRS. However, just by simply using a QI, it doesn't bless the results of the exchange. They're acting as a principal in this, and that there must be that qualified intermediary can't be one of those disqualified. It must be independent party and cannot be disqualified. The main role or the main duties of the QI is to hold the exchange proceeds. They're also going to prepare some legal documentation that includes the exchange agreement and the assignments for the relinquished and replacement properties, and also coordinate with the closing agents on both the relinquished and replacement property. And obviously I've talked about this for nearly an hour now. That the process has some very unique intricacies, and it's important to have somebody who understands those intricacies. So who is a disqualified person that I've mentioned a few times already? It's anybody that has been the taxpayer's employee, attorney, accountant, realtor, investment banker, broker, or as a relative, a direct line, which is defined within by the IRS in the past 2 years. So anybody who served for those in those capacities cannot act as the taxpayer's qualified intermediary, and it will immediately taint the transaction and will not qualify for 1031 treatment. So the safe harbor it's actually out there. And like I mentioned before, that one of the biggest tenets is to make certain that the taxpayer is not an actual constructive receipt of the money or the other property. Should any of those disqualified people be attempted to use as the qualified intermediary, it will, because the taxpayer has control or they've acted as their agent and can ultimately have control of those individuals, there's deemed constructive receipt of the exchange proceeds, and that's why the exchange is busted. The regulations dictate that in order to qualify as a safe harbor against the actual or customer receipt, the exchange agreement must limit the exchanger's rights also to receive, pledge, borrow, or otherwise receive benefit in money or other property, except after the end of the 45th day if there's been no identification, or the exchanger's ID'd property and the exchanger has received all properly identified property under the exchange agreement, or if there's a material and substantial contingency which is not clearly defined by the IRS. So that's another one where the tax advisors need to be consulted, or they can get any unused funds after the expiration of the 180-day exchange period. The safe harbor ceases to apply if they do violate any of those terms to receive, pledge, borrow, otherwise attain benefit, or receive any funds before the end of the exchange period. So there's a few different types of exchanges, and I've touched on a couple of them already, where there's a simultaneous exchange, and that can be accomplished without a QI, but in most cases still utilizes a qualified intermediary. Delayed or deferred exchange is also known as a forward exchange, which is the most common. Finally, a reverse exchange, or a reverse improvement or build to suit exchange. We'll get into, what we've talked about mostly so far is the delayed exchange or the deferred exchange. And now I'll touch on the reverse exchange. The reverse exchange occurs when the taxpayer wants to acquire the replacement property prior to the closing of the relinquished property. So what we've talked about is sale of relinquished property, cash goes to QI, QI uses the funds to buy the replacement property. So what ends up happening, instead of simply utilizing the service of a qualified intermediary, the taxpayer must arrange for what we refer to as an exchange accommodation title holder, or an EAT. And that entity will take title to the, in most cases, the replacement property until the exchanger has finally sold the relinquished property. The IRS does not allow the exchanger to own both properties at one time, so the need to have this independent EAT park the property enables the taxpayer to get the 1031 treatment within the safe harbor. It is much more complex than a forward exchange. It's much costlier than a forward exchange. There's a number of pitfalls and loopholes, not loopholes, pitfalls that could cause the taxpayer to just simply not be able to do the reverse exchange, because first of all, they've got to have the liquidity to be able to acquire the property. You know, do they have the money to buy this replacement property before selling whatever it is they're selling? There's additional title, escrow, and transfer taxes. There's also many restrictions on her that the EAT is going to have, where they're going to obviously require that it's commercial property. It's going to require a phase 1 environmental. They're going to require the taxpayer to carry the proper insurance. If there's any need for a lender, it can certainly disrupt that process as well. So as I mentioned, the capital, the financing, you still got your same time constraints of 180 days. So the taxpayer is still going to need to sell whatever it is they're selling within that 180 days to make it a viable 1031. And if there's a construction or improvements going on, obviously that's going to be under very, very tight time constraints, because any improvements need to be done before the 180th day. So finally, to kind of rehash what we've talked about, and the key points to remember: you must acquire like-kind property, and that's not by type or grade, but the purpose for holding the property. It's the productive use in the trade or business or for investment. We've got our 45 and 180 day identification and exchange periods, which are, pretty much locked in stone. There's no way to get an extension on them. The only time an extension is granted is if there's a presidentially declared disaster. To completely defer gain, we need to acquire property equal or greater in value, fair market value, utilize equal or greater amounts of the equity, and if necessary, acquire equal amounts of debt or replace it with additional equity. And finally, it's important to do your research when selecting a qualified intermediary. Appreciate your attention today, and although we don't have the opportunity for a Q&A session, my information is located on the last page. Again, my name is Jim Gudenau with First American Exchange Company. Thank you very much.